Hello, all. Welcome to today's session on tax planning and investment. My name is Saikat Roy, and I will be walking you through the session of today. Today, we have Rahul with me, who is my colleague, and he will be answering all your question in the chat box. A little bit brief about myself and Rahul. I'm a CA who is handling the internal tax team of Clear. Rahul is a qualified professional who is also leading the team with me. Now, let's try to take a look on the today's highlights. What are the topics we are going to have a discussion on? Firstly, we are going to look at who should be planning for their investment and what would make one person make investment. Finally, we are going to take a look at the various investment options available, how to take advantage of various expenses. We are going to have a little bit of understanding of the same as well. Also, we are going to see what happens if you do not submit the proof in case you have not declared the income proof or you miss the window to submit the proof. And finally, we are going to take a look at some of the things that we are facing during the year. Now, firstly, we should try to understand what makes a person plan for investment and its declaration. So, as of now, in India, there are two tax regimes available. One is the old tax regime, another is the new tax regime. Now, every beginning of the financial year, your employer asks you this question: under which regime you want to be taxed. If you are choosing the new tax regime, there is no need for you to declare any investment, right? There is no need for you to submit any proofs of any kind as well. Why? Because under the new tax regime, none of the deductions that you are making or investment that you are making are allowed as deduction. However, under the old tax regime, the option to deduct the income, reduce the income by the way of using all the investment opportunities is still available. Therefore, person who are opting for new tax regime, they are not required to submit proofs, but the person who are opting for the old tax regime, they are required to submit the investment declaration. Secondly, a person whose salary income is more than 5 lakh rupees, they should be making this investment declaration. Why? Because as of now, under the new tax regime as well as the old tax regime, if your income is more than 2.5 lakh rupees, but it is not crossing 5 lakh rupees, in that case, tax will be computed for you definitely. However, by way of giving you a relief, you are not required to make any payment of taxation either by yourself or by your employer. Therefore, if your total income is no more than 5 lakh rupees, you need not submit any proof, right? However, at that point of time, you must file your income tax return because your income is more than 2.5 lakh rupees. Furthermore, apart from investment, another thing we should keep in mind while making the investment declaration, that is income declaration. Now, many of us keep our money in savings bank account. Also, some of us invest some money in FDs and all, which in turn gives us some sort of interest income, right? If you are depositing the money in savings bank account or FD, by way of interest, you get some amount of money. And those two incomes are taxable in your hand. In case of savings bank account interest, there is a deduction of 10,000 rupees going on. Yes, definitely. But beyond that, any amount you are earning, that becomes taxable. Also, FD interest is always taxable. Therefore, if you have this earning, In that case, you are supposed to pay some taxes on that as well. Now, if the tax payable on that particular income is more than 10,000 rupees, in that case, advance tax liability gets attracted, right? And if you are not paying advance taxes on that, therefore, you are supposed to pay some amount of interest as well. Therefore, it is a very good idea to declare FD interest or savings bank interest to your employer who can compute the taxes based on that income as well and deduct the taxes. Therefore, you can save some amount of interest payment. Now, uh, now let's take a look at why should one person be making the investment. First and foremost answer that we land, that is to save the taxes. Yes, that's a very good way. Why should we save the tax, or rather, why should we invest? Second point is financial planning and saving for the future. Now, if you are investing the money, that actually creates a wealth, right? So 5 years down the line or 10 years down the line, if you plan to you know if you try to make a financial goal, as of now what we do is we go haphazardly towards saving the money. We don't really have any goals in our mind. What we do is we need to save the money, therefore we are saving the money. However, it's a very good practice to set a goal for future. For example, after 5 years time, you may be willing to invest in a car. Another 5 years later, you may want to invest in a house property. Now, if you have that kind of goal in your mind, the tax saving, the or the investing becomes much more easier for you. Therefore, you try to have a goal in mind before starting the investment. Further, if you are investing the money into a property, or you are investing the money in shares and stocks of companies, in that case you are generating wealth as well, right? If you are generating wealth, that actually means that in future you don't really have to worry for money, and you can keep doing whatever things that you love. Therefore, saving the money at this point of time is a very good idea. Further, another funny thing and why we should be making investment is reducing unwanted expenses. Now, at the beginning of the month, when we receive the salary, we tend to go out of our way to spend the money, right? So maybe there is a watch which we have been eyeing for quite some time, and since I have received the money, let's go out and buy it. So, to get rid of that kind of mentality, you should be investing so that you are left with lesser amount of money for this kind of unwanted expenditure. Now, uh, having understood why we should be investing, let's try to understand what are the tax saving expenses which can save us some taxes as well. Firstly, house rent allowance is there. Now, is a very common way to save the taxes. If you are staying in a rented place for your employment purposes, then there is a certain amount of rent that you can claim as deductible. However, there are certain misconceptions about it. People usually think that whatever amount of rent that I am paying or whatever amount of HRA that I am getting as component of my salary, that becomes deductible as HRA, which is not the correct thing. To get the HRA deduction, you need to look at three figures. Number one, 40% or 50% of the basic. Number two is actual amount of HLA that you are receiving. Number three is actual rent paid minus 10% of the basic salary. Now, out of these three figures, whichever comes lower, that is deducted as HRA, house rent allowance. We are going to take a look at this, how this computation actually works out at later point of time in this webinar. Now, second more interesting option. Second option to claim that deduction is leave travel allowance. Now, leave travel allowance, to summarize it, if you are traveling during the year, whatever expenses you are making on traveling, the flight ticket or the train ticket, that becomes deductible from your salary income, right? However, there are certain conditions attached to it as well. Firstly, leave travel allowance. This can be given to you only twice in a block of 4 years. Now, the first block, or rather the current block that we are in, that started in 2022, right? So we are at present second year of the block. Secondly, the travel must be within India, and you can take a dependent spouse and children with you. And thirdly, only to and fro expenses, either via first class train or economy flight, is allowed. Now, first class train, it also considers AC three tier or two tier. However, one thing you must keep in mind that no cab fare, no lunch, no hotel expenses are allowed to be deducted. Only to and fro expenses to the place that you are going are to be deducted. However, another point is, to claim leave travel allowance, it must be part of your salary. Now, sometimes organization, they give you an option to restructure your salary. They give you a bulk amount in your special allowance or other allowance. From there, you can allocate certain money for various other allowances. For example, leave travel allowance. If your company is giving you this option, then most definitely you should look into it, because it can save you some taxes as well. Now, what other expenses can be claimed as deduction? Similarly, if you have this option to uh, reallocate special allowance or other allowance to any other specific allowance, you should be taking that. And some of the expenses that can be claimed is petrol expenses for motor cars, uniform allowance if it is allowed, food coupon allowance, and mobile telephone telecommunication expenses as well. Now, petrol allowance, right now things are moving towards normal. Therefore, if you are traveling to office using your own car, then petrol expenses, and if you have a chauffeur who can drive you around, that expenses can be taken as deduction from the salary as well. But for that, you need to allocate certain amount of money. Food coupon allowance or meal allowance, the maximum deductible limit is 50 rupees per meal for two meals for 22 working days. However, this amount is not given to you. Instead, what employers do is they give you a food wallet sort of thing, or a special card is assigned to you, right? So, using those, you can purchase food, or you can purchase grocery items, which can reduce the tax liability as well. Now, what other expenses can be claimed? First and foremost, interest on home loan. That's a very crucial thing to claim. Uh, if you are paying any amount of interest on home loan, that interest is deductible up to 2 lakh if the house property is self-occupied. However, there are again certain clause attached to it. Firstly, the house must be completed. If it is under construction, you cannot claim the deduction for the construction period. However, since you are paying the interest, you can accumulate the interest, you can sum up the interest, and once the house is completed, you can go ahead and deduct this accumulated interest. But the point is, if you are doing that, this accumulated interest, which is to be claimed over a period of 5 years in equal installment, that amount plus the interest component for that year must be lesser than 2 lakh rupees, must not be crossing 2 lakh rupees a year, right? Furthermore, Another deduction for home loan is available for you, that is under section 80 EEA. Now, section 80 EEA is designed to work alongside section 24B. However, uh, if you are trying to claim deduction under section 80 EEA as well over and above section 24B, then certain conditions again need to be mentioned or rather met. Firstly, the loan must be coming from a bank. The loan should be sanctioned between the period 1st of April 2019 till 31st of March 2022. The stamp duty value of the property should not be more than 45 lakhs, and the house property to be purchased should be first house property of the person. Now, there is a situation wherein a person may have inherited a house property, right? In that case, Section 80 EA benefit will not be available because that person has already inherited a property. The property is registered in his name. So, therefore, if there is no house property uh, owned by the assessee, in that case, assessee can claim deduction under Section 80 EA. Now, let's try to take a look what other investment options are present under Section 80C. Now, 80C is the big daddy of deduction sections because it has all the deductions, right? It has PEF, tuition fee, LIC, and this is the most well-known deduction section of Income Tax Act because this is primarily designed to save you the taxes. Let's try to look at the sections or other options for which ATC deduction can work. Firstly, PF. PF can be of multiple kinds. Firstly, Employer Provident Fund. This is the amount, this is a contribution which is deducted every month from the salary. Secondly, PPF, Public Provident Fund, and VPF, Voluntarily Provident Fund, Voluntary Provident Fund. These two items you need to invest on your own. However, the unique thing about PPF, Public Provident Fund, is it has a exempt status. That means whatever contribution you are making, that becomes exempt. Whatever interest you are earning from PPF, that becomes exempt, and whatever amount you are drawing at its maturity, that is also exempt. Now, VPF is something that you contribute on your own. However, there is a certain restriction placed upon it. That is, VPF, if you are investing through your employer, it should not be more than 7.5 lakh rupees. You can invest more than that, however, that amount becomes taxable in your hand. Secondly, tuition fee for children. Excuse me. So, if you are paying tuition fee for your children who are going to school or college or university, in that case, any amount that you are paying for their admission or the actual education itself becomes deductible. However, it is to be noted that any developmental fees or any donations are not allowed to be deducted. Life insurance premium. Most of us have taken a life insurance premium life insurance policy for which we are paying a premium each year. The policy can be in the name of self, spouse, or children, and you can claim the entire amount of premium provided it is falling within the limit of 1.5 lakhs. Finally, principal on home loan. Now, principal, we have talked about the interest on home loan at length over here. However, principal on home loan can be claimed as well as deduction under Section 80C. Now, again, to claim the principal on home loan, the loan should be taken from a banking institute and the construction of that house property must be completed. Now, ELSS. ELSS has a tax saving instrument or rather tax saving opportunity embedded in it as well as creating a wealth. Because in ELSS, what happens? You are actively investing into mutual fund units, which has a special tax saver clause attached to it. Now, the best part of ELSS is it has a very less lock-in period as compared to others. For example, tax saver FD has a lock-in period of 5 years. PPF have a lock-in period of at least 15 years. Therefore, ELSS can have a very good impact in respect of lock-in period. Further, since this is a ELSS fund, if you are locking it for a period of 3 years and later on you are selling it or redemptioning it, in that case, the capital gains that you are having that can be on par of equity-linked mutual funds. As of now, equity mutual funds enjoy a special status, enjoy a special tax rate as well. So the any gains that you are making, which is not uh, 1 lakh rupees, is not taxed. Any gain that you are making, which is more than 1 lakh rupees, you need not pay taxes on 1 lakh rupees. However, beyond 1 lakh rupees, you need to pay tax at the rate of 10%. Now, tax saver FD, it has a lock-in period of 5 years. However, any interest that you are earning on tax saver FD becomes taxable in your hand. And other investment opportunities that can be claimed under ATC are Sukanya Samriddhi Yojana. If you have a girl child, you can start investing in her name whenever she is born, and you can start investing, or rather, you can invest up till she attains majority. You can use that proceeds to educate her further. So SSY can be a very good option for saving the taxes if you have a girl child. Also, National Savings Certificate and post office schemes are also there to save you the taxes if you are looking for a very safe way to save the tax and wealth creation. Further, other options are available under ATCR pension plans, which comes under 80CCC. However, it falls within the limit of ATC, that is 1.5 lakh rupees. Now, there are three options to save some taxes as well, which is NPS, right? Now, NPS has again a very unique characteristic attached to it. If you are going ahead and investing in NPS directly, it falls usually under ATC. However, if you have uh, other investment options as well, rather, if you have many other investments, in that case, if you are making investment in NPS, then you can get an additional deduction of 50,000 rupees if you are investing in NPS, right? So this is a special clause for investing in NPS. So effectively, if you have, let's say, 1.5 lakh rupees of ATC deduction, and over on top, you are investing additional 30,000 or 40,000, whatever it may be, you can get that amount of deduction for a category specially designed for NPS. However, that maximum amount you can deduct is 50,000 rupees. And finally, you can invest in NPS through your employer as well, for which maximum amount that can be deducted is 10% of your basic salary. However, the maximum amount that can be invested without any tax implication is 7.5 lakh rupees. Now, these are the tax saving instruments that are available for you under the old tax regime. If you remember at the beginning of the session, we have mentioned that there are two tax regimes prevalent in India right now. One is the new tax regime, another is the old tax regime. Now, since we have discussed at length about the old tax regimes, now let's try to look at the new tax regime as well. As per the data, very less percent of people are investing in or rather going with the new tax regime. However, on paper, new tax regime looks very, very attractive because that rate of tax that get the incremental rate of tax is very less as compared to the old tax regime. So every increase of 2.5 lakh rupees of income increase result in increase of tax rate of 5%, which as compared to new or old tax regime looks very enticing. However, if you have investment, and most of us have this investment, tax saving investment and expenses with us, the new tax regime becomes less attractive. Why? Let's try to look at this with an example. Now, for this example, we have created a scenario where a person is staying in Bangalore and that person is paying a rent of 20,000 rupees a month, right? The salary structure of that person is 5 lakh rupees of basic, 20,000 of HRA, and other allowances of 3 lakh rupees. So, all in all, that person is getting salary income of 10 lakh rupees. Now, if we look the from the gross salary of that person, w- under the new tax regime, we will be deducting nothing. However, with the old tax regime, we will be reducing 1,90,000 rupees as HRA, standard deduction of 50,000 rupees, and professional taxes of 2,400 rupees. Now, HRA, how is it computed? If you can remember, we have said that the HRA deduction should be lesser of three figures. Number one, 40% or 50% of the basic, the actual HRA component, and rent paid minus 10% of the basic. Now, over here, 40% will be applicable because that person is staying in a non metro city. Now, non metro city for this purpose are all the other cities except for Delhi, Mumbai, Kolkata, and Chennai. Since that person is residing in Bangalore, that becomes a non metro city. Therefore, we will be looking at 40% of the basic. The 40% of the basic becomes 2 lakh rupees. HRA given to this person is again 2 lakh rupees. However, rent paid in Bangalore is 2 lakh 40,000 rupees minus 10% of the basic, that gives us 1 lakh 90. Now, if we compare these three figures, HRA deduction becomes 1 lakh 90,000 rupees. Therefore, that is the amount of HRA deduction. After reducing standard deduction and professional taxes, the total salary becomes 7 lakh 57,000 rupees under the old tax regime. Under the new tax regime, it becomes 10 lakh rupees. Now, as we have mentioned, under the new tax regime, no deduction are available. However, this person has made significant investment in some tax saving investments, right? So for this person, there is a LIC deduction, ELSS deduction, SSY deductions, and all, and some medical insurance is there as well. After taking all this deduction, that total taxable salary becomes 6,19,000 rupees under the old tax regime, but under the new tax regime, it still remains 10 lakh rupees. Now, if we look at the tax computation, up to 2,50,000 rupees, there is no taxes under both the regimes. However, from 2,50,000 to 5 lakh rupees, the rate of tax is 5% under both the new tax regime and the old tax regime. So 12,500 will be applicable under both the regimes. However, the divergence becomes clearer over here. So from 5 lakh to 7 lakh 50,000 rupees under the old tax regime, the rate of tax is 10%. So income increased by 2 lakh 50,000 rupees, tax increased by 5%. Therefore, at the rate of 10%, I will be paying the taxes, which becomes 25,000 rupees. Now, from 7 lakh to 10 lakh rupees, the rate of tax is 15%. Therefore, the tax becomes 37,500 rupees. Total tax on this 10 lakh rupees of income becomes 75,000 rupees, and after including health and education cess, the total tax payable becomes 78,000 rupees. Now, under the old tax regime, up to 5 lakh rupees, the rate of tax is 5%, which is giving me a tax of 12,500 rupees. And from 5 lakh to 10 lakh rupees, the rate is 20%. However, the income increased in this context is only 1,19,000 rupees. So if we compute the tax at the rate of 20% on 1,19,000 rupees, it becomes 23,800 rupees. Therefore, on 10 lakh rupees of income under the old tax regime after taking deductions of all kind, we come to a tax payable position of 37,750 rupees, which is inclusive of 36,300 rupees of taxes and 1,452 rupees of health and education cess, thereby giving me a tax saving under the old tax regime amounting to 40,248 rupees. Similarly, if we are investing in NPS, then we can also save a huge amount of taxes as well. Now, in this scenario, we have taken that apart from ATC and ATD, we are investing in NPS. The amount that we are investing is 65,000 rupees, right? However, this amount is limited to 50,000 rupees. Therefore, if we belong in a 30% marginal tax rate, we can easily save 15,000 rupees of taxes. And if we take health and education cess, then tax saved amount will become 15,600 rupees. Now, going beyond ATC, what are the other sections under which we can save the taxes? Firstly, Section 80D, which gives us a benefit of tax saving if we invest in health insurance policies. Now, if we are investing in health insurance policies, any amount of premium that I am paying becomes deductible in my hand up to 25,000 rupees in case I am not a senior citizen. For my dependent parents, the limit is also set to 25,000 provided they are not senior citizen as well. Now, all in all, I can save 50,000 rupees in case of dependent parent and self both are non-senior citizen. However, if parents are senior citizen, that limit becomes increased to 50,000 rupees. In case I am also a senior citizen, then the deduction becomes 50,000 as well. One special allowance is given to dependent senior citizen that if they are not covered under any medical insurance policies, in that case, medical expenses up to 50,000 rupees can be claimed instead of medical insurance policies. However, it must be noted that they should not be covered under any medical insurance policies. Sometimes the employers give their employees a benefit of group insurance. If they are covered under that group insurance policy, then also Section 80D deduction will not be available for them for medical expenses. Now, what are the other sections under which I can claim deduction? Firstly, Section 80DD. Now, this section actually applies when one of the dependent of the person, taxpayer, is differently abled. If the disability limit is more than 40%, but it is less than 80%, in that case, 75,000 rupees. If the disability is more than 80%, in that case, 1,25,000 rupees. If the taxpayer or any dependent is diagnosed with specific diseases, in that case, for medical expenses, for them, maximum 40,000 rupees is deductible or the actual medical expenditure. In case the affected person is a senior citizen, then maximum 1 lakh rupees can be deducted for their maintenance. However, there is a specific list of diseases under which these can be claimed. Some of the diseases are Parkinson's disease, motor neuron disease, uh, cancer, AIDS, etc., etc. Now, if assessee himself or herself are differently abled, in that case, similar to 80DD, if the disability limit is up to 40%, sorry, more than 40%, but lesser than 80%, 75,000 rupees will be deductible. If the disability limit is more than 80%, in that case, 1,25,000 rupees can be deductible. Further, if you have taken a loan for higher education, in that case, any amount of interest that you are paying becomes deductible. The loan can be taken for education of self or any dependent. Further, if you are making a donation in a charitable institute, then 50% or 100% of such donation can be claimed as deduction. Now, uh, having understood the deductions and everything, let's try to understand some of the tidbits, the internal workings of the taxation system. Firstly, at the beginning of the year, our employers tells us to choose between one of the regime, old regime or the new tax regime. If you are choosing the new tax regime, then yeah, it is absolutely fine. If you are choosing the old tax regime, you are additionally asked to submit declaration, right? So this requires actually to plan your investment. So during the year, or rather at the beginning of the year, you have a notion that I will be investing XYZ sum of money. You should be declaring the same, and diligently you should be making those investments, because at the year end, usually in the month of January or February, every employer starts this process of investment proof submission, wherein you are asked to submit the proof of you making those investments. If you are not declaring or if you are not submitting any proofs, then whatever declaration you have made at the beginning of the year, that will be ignored completely and your tax calculation will be done afresh. Since in this new fresh calculation, no tax investment is declared, or some of the investment are declared, or proofs are declared, the remaining undeclared investment will be ignored, which will increase your total taxable income, and it will increase your tax liability as well. Therefore, if you are not submitting any proofs, be ready for higher tax deduction in these last 2 3 months. However, the world does not end at that point of time, because at the time of filing your income tax return, whatever proofs you did not submit can be shown as deduction, and you can get if any additional money has been deducted as taxes. Second point you should be keeping in mind during the year, if you are switching jobs. Now, if you are switching jobs, it's your duty to declare previous employer's earning and tax deducted to your current employer to make your life much more simple. Because if you're switching the job, then what happens is your employer, the current employer, thinks this is the first employment you are having during the year. Therefore, they start giving you the basic exemption limit, standard deduction, and every benefit available, which in turn will reduce your tax liability. However, since you are already working in an organization previously, they have also considered the same. They have also considered the basic exemption limit, the standard deduction, the ATC deductions, etc. etc. Therefore, uh, at the time of filing your tax return, it will be seen that you have paid a lesser amount of taxes, and you would end up paying a huge amount of taxes along with some interest as well. Now, if you are switching jobs during the year, it is very much prudent to check with your employer whether you have declared any additional income or previous. employer's income to your employer as well, new employer as well. One red flag could be, since you are switching the job, since you have switched the job, obviously you have gone for a hike, right? Your salary may have increased 30%, 40%, whatever it may be. If this is the situation, then most definitely your tax deduction will be higher as well. If it does not happen, if you see your tax deductible is lesser or at the same level as the previous employment, then it should be a red flag to you. There is some sort of inaccurate tax calculation happening, and you should check whether you have submitted all the proofs, the incomes, and everything of previous employment to your current employer as well. If you have not, then you should be submitting all the incomes and tax deductible from your previous employment, because this will save you a lot of tax outflow at the end of the year. Now, we are at the end of our session. I will be taking up some of the questions which may be coming. All right. So we are at the end of our session. Thank you all for joining with us. I hope you have taken away some of the learnings and you will be applying and putting them to good use. Thanks for joining again. Have a great day and have a happy weekend. Bye bye.